Thanks very much for your time. Just very quickly, Cadence Capital. Why Cadence? What does Cadence mean? Cadence is the ebb and flow of the tide in the ocean as it goes in and out. It's the revolutions on a bicycle that you do in 1 minute. It's the timing in music. Basically, it reflects the ebb and flow of everything. And so it is with the stock market. There's just very, very extreme ebbs and flows in the stock market, and nothing stays the same forever. And the idea that you're going to be in something and it's going to be good for you for the rest of your life, or that it's going to be good forever, is unfortunately not the way of the world. It's not the way of the world in anything. But it is, so we have to acknowledge that everything goes in cycles and that stocks do the same and markets do the same. So what can we do about it? The first thing is to accept that that is what happens. Don't be in denial and think that resources are going to go stronger for longer, stronger forever, China, India, Chindia stronger forever. Don't accept that small cap stocks in Australia will go up forever. Don't accept that the US market is going to go up forever. What you have to have is you have to have a process that gets you into positions and scales you into trends and gets you out of trends. And if you're not doing that, you might capture one part of a bull market in the resources in a certain part of the world, but you're just as likely to capture the fall on the other side. Or if you're only in one type of mandate, which is a small cap stocks in America, you're going to capture the upside, but you're also going to capture a lot of the downside. So that's not really what we do. So I'll go into a little bit of what we do. We're a listed investment company. It's $450 million of funds under management. I started this, it's 15 years ago. I put nearly all of my money into this fund, and ever since then I've continued to just put the majority of my net worth into this fund, and so have many of the people that work with us. So what you're looking at here, I don't know what other presentations you go to or what other institutions you go and look at their presentations. I have the majority of my wealth in this business, and no matter what happens, I'm going to be pretty focused on this fund. So you don't have to even necessarily believe me on that. I'm just telling you that that is what's going to happen because the majority of my wealth is here. So if things go well, I'm going to be here. And if things go badly, I'm going to be here recovering as well. So I've been through 4 bear markets, and I've been through 4 bull markets with this fund. I've been through 5 bear markets myself, investing my own money, and I've just about onto my 5th or 6th bull market with my own money now as well. So, and I know that things just ebb and flow, and it's always going to be that way. So we're a long short fund, but we're long biased, and we invest domestically, and we've started to invest offshore as well. And unlike other people who say, I've set up a local fund and then an international fund, what we did was we just started to dip our toe in the water in international stocks and see how we were going, and it's worked out pretty well. So we've got a bigger positions starting to occur in international stocks. Why did we dip our toe in the water and not just go full blast into it? Well, because it's our money. Right? We're not going to take massive risks on something that we haven't done before, but it is starting to work well, and so as it works well, we'll expand that way. We've done around 15.5% per annum, and the All Ords has done around about half that, I think. And we pay out a lot of fully franked dividends. We pay about 6 to 8% fully franked dividend yield over that period of time. Actually, we've paid out more dividends with franking than our current share price. And for the first time in 4 years, I'm getting on stage and saying to people that I'm actually trading at NTA today. We've tended to trade at about a 10-15% premium to NTA. I don't know if you've heard other people say today, we're trading at this premium or this discount or that discount. We're currently trading around NTA. And so, previously I've got up to people and said, I'm at a 15% premium to NTA, don't buy our shares. Now we're around NTA, so that's probably, all things being equal, not a bad entry point to the stock. I've already mentioned we're all big investors in the fund. In fact, we are the largest investors in this fund and continue to be the largest investors in this fund. More than half of our investors are self-managed super funds, as you'd expect, because we're delivering fully franked yields, and we're delivering a diversified portfolio and a pretty unique process. We've got a recommended plus rating from ratings agencies, and we're covered by a lot of research brokers and broking houses. And we rank amongst one of the top performing LICs in Australia. That's our team. So it just started with me 15 years ago, then Wayne joined. I've known Al Crozier for 20 years. Charlie joined us nearly a year ago. Michelle floated our company with the ASX, and Ian, that was 13 years ago nearly now. And Kirsty joined us from Shaw Stockbroking, and Tracy's joined us from BNP Paribas. She's running operations with Wayne. And we're about to employ another person as well. So obviously we have to keep growing and improving the quality of the team as we do. So what is it that we do? We use a combination of fundamental and technical research because we believe that delivers a better risk-adjusted outcome for us than one of or other of those things alone. I would hope that almost everyone that's got up here today has said to you, I like to buy low and sell high. We like to buy cheap things and we like to sell expensive things. And we do that all day long. So the real question is, if everybody's buying low and selling high, how come everyone isn't outperforming the index every day? Right? Because it's a little bit more difficult than that. And actually, I think the reality is that probably, and I don't have enough time to go into this in a great deal of detail, we also have a few additional rules that say we're not allowed to buy stocks that are falling and we're not allowed to sell stocks that are going up. Because it might be your view that a stock's cheap, but it might not be. It might be your view that a stock's expensive, but it might not be. So we have a lot of rules in place to prevent us from making very human mistakes and very emotional human mistakes that occur on a regular basis. Back to that word cadence, right? We know with cadence that when the world gets super bearish and they think there's a global financial crisis on and we're not quite even sure what that means, everything collapses. And then when it's going to be Chindia, China, India, resources forever, the resources go to stratospheric prices and we're all going to think it's going to happen forever, and it doesn't. It just doesn't. We're not buying low and selling high in those examples. So what we do is we visit about 600 or 700 companies a year, and we're looking for those stocks that are cheap and expensive to us, and we use PEG ratios, operating cash flow yield, free cash flow yield, balance sheet strength, and industry positioning. We've been doing that for a long time, and we have very detailed exit and entry strategies for our stocks. Here's a bit of a background on what we've done. I think I've spoken to most of this. Since inception, we've done 15.5%. The market's done 6.9%. Now, the market's 6.9%. I think for a while back there, at one stage, leverage long was popular, then short funds were popular, then neutral funds were popular, then I think exchange-traded funds became popular, where you just buy the index, and then I think people are discovering that the index isn't doing that well. 6.9%, you don't get much franking out of it, so that doesn't work either. But these things also go in trends. The type of stock the funds that are popular go in trends as well. But importantly, there's that significant outperformance over time, and very importantly, it's the compounding effect of that over time as you invest and invest and reinvest, where you get the really big returns. I've spoken to these dividends. We pay out as much as we can. We pay out specials when we can. I mean, sometimes I get telephone calls saying we're paying out too many dividends, right? Too much dividend. And then other people ring up and say, can you pay me more dividends? So with 8,500 shareholders, it's difficult to satisfy everyone. But we try to pay out. We don't believe if we're paying 30% tax inside the structure, that if we make $10, $3 of it goes to the tax department. And then some companies say we don't pay out dividends. Yep. So now you've paid out the $3 to the tax department. If you've got a self-managed super fund, you want that $3 back. The only way we can get that back to you is by paying you a fully franked dividend. So if someone's not paying you dividends, the most they can deliver you on a $10 return is $7, because $3 of it's gone to the tax department. This is a list of our holdings. You will find if you look at our portfolio and join our newsletter on a monthly basis, which I encourage you to do, you'll see our bigger positions getting bigger as we add to them. You'll see our smaller positions getting smaller and going out of the portfolio as we sell them. So you will start to see a very different profile to an index fund or a fund that has 20 positions each with 5%. I never forget thinking hard about modern portfolio theory one day when the professor was saying if you buy 20 stocks, you eliminate 85% of most risk. And so then you keep 5% in each of them. If one of them halves, you add it back and you get 5% again. And if one goes to 10%, you sell half of it and you're back at 5%. So what you're doing there is you're cutting your winners and you're adding to your losers. So we don't do that. We add to our winners and we cut our losers. So we do exactly the opposite of what modern portfolio theory does. And we can go back to any of our stocks in detail if you like a little bit later. So a little bit about what we're doing at the moment. We're in the process of doing verification. I've just been doing that this morning to set up a new fund. And it is the same process, fundamental and technical research, investing domestically and internationally. And the difference is that what we do now, where we scale into positions and scale out of them, tends to take about 1 to 3, sometimes 5 years. Our Macquarie position's been in there from $25. It's about 5 or 6 years nearly now. And our Melbourne IT position's been in there for 4 years. Emeco's been in there for nearly 2 and a bit now. So these things take time to unfold. In between all of that, there's a lot of volatility and there's a lot of things happening where you're missing out on opportunities that occur over the 6 to 18-month period. And that's specifically what this fund has been set up to do. The other thing about this fund is that each position will start as half the size of our existing positions in our existing fund, which means there'll be more diversification across the fund. We hope to get similar results over the longer term. We've done quite a bit of testing on this. We think it might possibly be ever so slightly lower return, but lower volatility and lower movement in the portfolio overall. And of course, in these periods of volatility, this fund with 6 to 18-month duration should benefit more than the established fund. And just to go into a few specifics of what we do, this statistic never ceases to amaze me. There's about 50,000 stocks in the world listed. Most of them lose money. So in the most sophisticated form of capitalism in the world, which is the listed stock exchanges, most of the stocks lose money. In Australia, there's 2,000 stocks. Most of them lose money. About 700 of them make a profit. And even more disturbing than that is that of the 700 that make a profit, most of them are truly average. They have no special redeeming features about them whatsoever. They might be on 14 or 15 times PE. They're growing at 5 or 6% per annum. They've got a couple of divisions. They've got a couple of managers that have come from disparate parts of the community or disparate parts of the world. They don't really own any shares. They get paid a salary. They go home. There's really nothing particularly special about these companies. And they're in the paper every day and in the news and they're on television and we talk about them and we write long journals about them. But that isn't what we do. Every year in Australia, there's about 35 stocks that are really cheap, and there's 35 stocks that are really expensive. And when things get extreme, they get interesting. And that's where you make the money. So this idea that a Domino's pizza might be on 65 times PE is almost mind-blowing, but it happened. The idea that a stock during the GFC that produces $75 million of net profit might be on 2 times cash flow, it's hard to believe, but it happened. The idea that a technology company would trade at less market cap than the cash they have in the bank, i.e. someone pays you negative 3 cents to buy their shares off them, it's hard to believe that that would happen, but it did happen. So this is when it really gets interesting. So we're looking for those extremes, both here and overseas. So when people say to us, how can you do it? The reality is we're not actually scanning the entire globe, looking at all stocks, becoming experts in everything out there in the world at any given moment. We're just zoning in on the things that meet these criteria, and we do it continuously. And we're looking for our fundamentals. We're doing stock profiles the whole time. Is it growing at 20% per annum? Is it on a PE of 15? Does it have 8% operating cash flow yield? Does it have 5% free cash flow yield? Does it have no debt and lots of cash? That's interesting. Conversely, is it on 65 times PE, growing at 25% per annum with plenty of debt and no cash? That's interesting from a shorting point of view. And we're just doing this every single day. I mean, you don't need a rocket science degree to do this, right? This is year 10 maths. So it's not the mathematical portion of this is not particularly challenging. It's getting out there, seeing the companies, and one really challenging component to the financial services that I didn't realize 15 years ago, which took us a long time to raise money, was that the industry doesn't like you to be doing this. They want you to be doing resources or 10 technology stocks. So they want you to specialize in transport so that you know exactly what type of tires the trucks are using and whether they're a positive tread or a negative tread or whether they're, I mean, all sorts of inane bits of information that don't help you make investment decisions. But really, because there are so few stocks that meet our criteria at any given moment, we can't afford to just specialize in one thing. Otherwise, we'd only find one opportunity every couple of years. And so here's the important piece of all of this. If you don't, I only want you to remember one thing. That's this year. And that is, we scale into our positions on the way up. And we scale out of our positions on the way down. That's it. And this is incredibly difficult to do because it goes against human nature. As a position goes up, you want to sell it. And when it goes down, you're hoping like crazy that it goes back up. And then it goes down a bit more, then it goes from $1 to 80 cents. You say, oh, if it goes back to $1, I'll sell it. And then it never does. But you're hoping it does. And then if it goes from $1 to $1.20, you go, oh, geez, I've made 20 cents, I better sell that. Nobody ever went broke making a profit, right? Nobody made a lot of money selling a share that they bought for $1 for $1.20. That's not how you make the money. So the 5 baggers, the 10 baggers, the 20 baggers are made adding to your positions as they go up. So that's it. That's what we're known for. And why do we start looking at things at the bottom here, that top chart on the left-hand side with the green dots? Because it was cheap. Because everybody was selling it. Because we have our AGM 4 years ago, and I was buying Macquarie Bank at $25, and I've got it on video that my shareholders, some of which are here today, burst out laughing at me. How could you buy Macquarie Bank? Everybody hates Macquarie Bank. It's a basket case that's going to go bankrupt, and it's a joke. 3 months ago, I sold 1/3 of our position at $128 after getting a Sydney Airport spin-off for another $8. And the shareholder rings me up and says, how can you sell 1/3 of your Macquarie position? Are you out of your mind? That is the most amazing company. It's one of the best companies in the world. So, I mean, I can never get it right because my shareholders, there's 8,500 of them. At least 1% of them, 85 of them, on any given day will be having an emotional day. So they will be emotional that I'm selling Macquarie, or they'll be emotional that I'm buying Teva Pharmaceuticals, or they'll be emotional that something's happening. But that is why we have this process in place, so that our guys, when they come in the morning, and girls, they're not thinking, oh, I feel emotional about Macquarie Bank, or I'm feeling this, or I'm feeling that, or I'm feeling a bit nervous today because the stock market's off 3 days in a row. Yeah? So, what shall I do? So really, we know what to do. There'll be some stocks today we come in where we're selling 1/3 of them. Amazingly enough, there's stocks we're actually buying in this environment that are going up. So, I mean, we're all nervous, and private equity is out there bidding for companies and taking them over one at a time. Okay, so the new fund will benefit from the shorter moves within these longer-term moves from a 6 to 18-month period. We've been missing out on those opportunities, which we should be getting. And conversely, I'd just like to show you the way we short positions. Actually, go back a slide. The bottom left-hand slide with the orange dots on it, this is the most difficult thing in the world for humans, animals, because we are a form of animal, to do. We all know how to buy, but we all find it very difficult to sell. When shall I sell? When's the right time to sell? I bought the house. I was the person that put my hand up. I was the last person to put my hand up, so I won the auction. I now own the house. That was easy. Now when I go to sell it, I have to repaint it. I have to fix the electrical switches. I have to fix everything. I have to spend a whole lot of money. I've got to get an agent involved. I've got to advertise it. I've got to play them. I've got to get everyone come through the house. It's a nightmare. Selling is a lot more difficult than buying, and so it is with stocks. The key is when it drops a certain amount, you sell 1/3. And then you sell another 1/3, and then another 1/3. That's how we do it. I can tell you that in 10 seconds, but the thing we struggle the most with is selling. Selling 1/3. You just have to get used to it. And how do you short stocks? The same way. You sell 1%, then another 1%, then another 1%, and you buy them back 1/3, 1/3, 1/3. Same process in reverse. So let's talk about the banks. You know how we said you want to own something forever, and then you just want to sit? Actually, I think Warren Buffett's the one that says the best duration to own a stock is forever. And my AGMs always say, who owns a stock? Who has owned a stock forever? Well, the answer is no one, because we're not going to be here forever. But then you ask someone I haven't personally owned a stock from the first day I started in the funds management industry. I don't own one stock that I bought the day I started. The longest I've ever owned a stock is 10 years. Or maybe I'm not, I'm not that style of investor, but difficult to hold things forever. Because there's a better way to make money. This is the banks. They go all the way up, they go all the way back down, they go all the way up, and they go all the way back down. And here's my prediction for the future. They're going to go all the way up, they're going to go all the way back down, and this is during a bull market, I might add. This is during a period when interest rates have fallen from 17.5% to nothing, or what, close to nothing, and then they're going back up again. So against this backdrop, you don't want to be just holding this forever. You want to be owning it on the way up, selling it on the way down. Owning it on the way up, selling it on the way down. And as long as you've got a strict process that allows you to do that, you do it. Now, where are we sitting at the moment with a bank? We're sitting at a bank on 14 to 15 times PE, growing at 3 to 5% per annum, not reading our PEG ratios. Operating cash flow yield, not bad, fair to middling. Doesn't meet our fundamental criteria. This could only ever be a trade under our criteria. Hence, we don't own banks. How easy was that? We just eliminated 26% of the entire market in Australia by doing some analysis on it and saying it doesn't meet our criteria. But there is an opportunity to make money when it reaches new lows. When there's a Royal Commission on, and a this commission, and a that commission, and an APRA, and a this, and a that, and everyone gets truly bearish. Now let's just see how bearish they get over the next couple of months. And then maybe that's the opportunity. Or just after the global financial crisis. We actually owned banks just after the global financial crisis. They were on 9 times PE, and they were growing at 11% per annum. Of course, my shareholders are out of your mind, right? Buying those banks as they were recovering. But that's the way of the world. Here's one that we got wrong in our existing fund. We made some money, but you can see how extreme the moves are short term here. And in the long term, we bought it about $3.25 and we sold it about $3.75. So we held the stock for 4 years and we made 50 cents return with all that volatility. That's not the way to own Independence Group. The way to own this stock is to buy it on the way up, sell it on the way down, buy it on the way up, sell it on the way down, and buy it on the way up. We would have made a lot more money. And this is repeating itself at the moment with BHP, Rio, Oz Minerals, and so many other stocks. They're just doing these extreme gyrations in a slowly moving upward resources. Because we are, in the end, in a resources boom at the moment. The resources index is up more than 100% from the bottom, and that is quite clearly the definition of a resources boom. And that's good. I mean, that's good for the Australian economy. The resources, so here we are again. We've just written off the banks, 25% of the index. Here we are with the resources, the other 25%, and this is very interesting and useful ground for Cadence's process. And then, of course, there's all the other stuff that because of our privileged position of being a manager, having a license, being in the community for stockbrokers and fund managers and investment houses and insurance houses, when things happen, we'll get a telephone call. There'll be placements, share purchase plans, dividend arbitrage. Not so much convertible note arbitrage now, but when I started 15 years ago, there was a lot of convertible note arbitrage and dual listed arbitrage and block trades and special situations. We get those calls, and we're hiring someone specifically to handle those calls going forward and to handle all of that information that comes to us. And that creates additional opportunities that are generally not available to the public. Not because, I mean, if the general public spend enough time on it and get enough, if they can get enough funds under one entity, they could probably do it as well. But it is quite time consuming. It's a full-time job in itself. And there is a lot of money around in the world at the moment, so these opportunities are not as lucrative as they once were, but they will be again. Okay, so what have I just told you about? I've told you about our fund. It's 15 years old. I've got a 25-year track record. We're a long biased, long short fund manager. We have an open mandate. We invest domestically and internationally. That open mandate is extremely important to deliver what we do. Our track record is double, if not more, than the overall All Ords Accumulation Index. And we pay out a lot of fully franked dividends. That's 6.4% fully franked. I was at a property trust the other day, and they said, we pay out 6.4% yield. And I went, I couldn't see that in your numbers. And they said, well, and then I realized I'm thinking company. I'm thinking 6.4%, which is a yield of 9.1 grossed up. They quote their stuff gross. So they're at 6.4 gross. So they're at a different number net, right? So we're at 9.1 gross and 6.4 net. We've set up this new fund to capture those opportunities between 6 and 18 months as opposed to what we currently do. And we're going to be using exactly the same process as we're using now. Now, we've only soft launched this. So we've put a note out saying we're getting it ready. And we've had inquiries come back to us. There's about 3,000 people have put down their names to get involved in this. And pleasingly, about 600 of them are new shareholders. They're not existing shareholders of our fund now. And so, and that's before the prospectus is ready. But once it's ready, we will obviously distribute it to people. And they'll have an opportunity to invest in the new fund. Importantly, so So all of this stuff that I'm telling you, or I'm just rushing through at the moment, none of this is proprietary. Everything that I'm telling you, I have written articles on. I've got a 12-part investment series on our website. I've done video interviews. I've done videos on all of this. We've done book reviews. We've done live monthly updates for the market when they've wanted it. We're going to be on TV every fortnight now with Channel 9 and Sky News for about 15 minutes or to half an hour. We just want to get this information out to people. So I really encourage you to go to our stand afterwards, if you're not on our newsletter, to join the newsletter. And there might be something there that tweaks your interest, because it is, if nothing else, I'm just inherently interested in stock markets, and I'm quite interested in letting the information be known and disseminated in a transparent way, and that's what this is all about. Oh, Livewire, we do Livewire live interviews, and this Domino's thing that I was just mentioning, we went into great detail on that short and why we did it and what was involved, and we would encourage everyone to be involved in that. Just finally, for the new fund, I think Michelle and Kirsty are on our stand, and they are taking people's email names if they're at all interested in the new fund. So if you do have any questions, any interest, if you want to follow up, please come and see us. Thanks for your time.